Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In this edition of the Investment Trust podcast, I talk once again to Andrew McHattie, the editor of the Investment Trust newsletter, and a regular now on the podcast. It's been another interesting week, it always is, and this week we've had what has become the usual spate of mergers, rollovers, manager changes, and results, and there's plenty to get our teeth into, so let's dive into that, Andrew, shall we? I should just say, by way of background, been another interesting week in the markets. Yields have gone up and prices falling in the gilts market ahead of the budget. That's what everybody's focus is over here at the moment, I think. But let's kick off with a big news item, I think, and a very interesting one for the investment trust sector. And that is the announcement by Smithson, the global equity investment trust managed by Terry Smith's Fundsmith Group. They are going to be leaving the investment trust sector. So perhaps you could fill us in on what they are proposing, and we'll get into the whys and the whats of it in a moment.
Yes, thanks, Jonathan. I think we've got quite a lot to say about this because I do think this is a really major event, actually, in the investment trust sector, because Smithson is a far larger trust than many of those we've seen disappear. And I think this is of greater significance. So let's get into it. This is a big international trust. It invests in global, mid and smaller companies. So it had its place in our sector, but it's now disappearing because it's going to convert into an open-ended fund, or also offer you a cash exit. And our friends at Saba are behind this again because they have a very big stake in this trust, actually a 16% stake. And I think it's worth pausing, actually, to think about what that means in cash terms. That's actually about £270 million, that stake. And it shows you just how much money they're putting to work, actually. They really are a big, big force in our sector. And what's happened with Smithson is that actually, since launch in 2018, it did very well initially in its first few years, probably up to 2022, I would say. And then it started to underperform. It had style headwinds and kind of went out of favour. And since then, it's been pretty poor. And now Saab has taken advantage of that, I think, to push for change. The shares were trading on a significant discount, of course, which was why it moved in. And now they're able to get out at a zero discount. So I think it's a very significant win for Saba, first of all. And it's only going to encourage them to come back for more. But now the trust is proposing to switch into an open-ended fund. And in many respects, I see the rationale for that. I don't really want to admit that because I love our investment trust structure, but I don't think Smithson was really taking advantage of that structure very much. It wasn't investing in illiquid assets. It wasn't using gearing. I don't think it's going to make that much difference to continuing investors if they're in an open-ended fund.
Yeah, and that's, of course, been one of the issues that's been simmering along, if you like, behind this period of change we've had. And it seems to be coalescing around the idea that if you're going to be an investment trust and you want to survive, you have got to use those advantages that the investment trust structure has. And if you don't, then you are vulnerable to this kind of proposal, if you like, or attack, if you want to call it that, in the case of Saba. And it has been their case, their argument from the beginning, pretty much. I mean, after that initial campaign when they tried to take over the management of the trust themselves, or at least said that was their objective, they did then have another follow-up where they actually pushed this idea of essentially forcing investment trusts to convert into another structure, open-ended or possibly an ETF. And it looks like this will go through, I think. The board has done a lot. It's bought back an awful lot of shares, as you said, but that's had very little impact on the discount. They also introduced a continuation vote proposal saying that they would have one every time in any year when the discount was more than 10%. That was a more recent innovation to try and deal with the discount, but that hasn't seemed to have had much impact either. And it's a very big trust, as you say, 1.8 billion. And I think you can perhaps understand in this case why Terry Smith, the founder of Fundsmith, is also voting in favour of this change, because one of the other innovations that the board brought in was they charge fees on market capitalisation rather than on NAV. And in an open-ended structure, Terry Smith and his colleagues at the management group are going to have a much more secure and indeed higher income from managing the trust. So I think it is a sad day in a way for the trust sector. And I think perhaps a pointer to the vulnerabilities that are facing any trust that doesn't use the structure.
I think that's right. And that there are a few lessons to be learned here, I think, Jonathan. I mean, one is that, first of all, Smithson really did buy back in big volume. It spent about £1 billion on buybacks, buying back about 40% of the shares. So you can't say it didn't try. And I think we're getting more and more evidence now that buybacks don't actually function very well to narrow discounts. They can enhance net asset value, that's one thing, but they don't seem to work to narrow discounts. I think another point is that we're just living in an increasingly intolerant world in so many respects, aren't we? But you're not getting any time anymore. And I think there's been a shift here that whether you're a football manager, an investment trust manager, or a politician, you're under tremendous scrutiny, I think, now, like never before. And I don't think you're being given any time, because my sense is that the underperformance here didn't really last that long. It wasn't that bad. Actually, since launch, this trust has been absolutely fine. It's delivered 8% a year, which is ahead of its benchmark. And I think in normal circumstances, if we go back a few years, the market would have been pretty patient with the managers here. But we don't have that luxury anymore. So I think this is a faster moving market. Just one more point, which is that, unfortunately, Jonathan, this trust continues the terrible tradition of massive investment trust launches with great fanfare turning sour. If you remember, this, of course, happened with Woodford Patient Capital Trust, with Amerindo Internet Fund, Fidelity China Special Situations, and going a bit further back, Mercury European Privatisation and Kleinwort European Privatisation. Basically, whenever a massive new launch has broken records, and actually Smithson raised over £800 million in 2018, it tends to go wrong, I'm afraid.
Well, it's a sort of boom and bust cycle, isn't it? Yeah, the more popular you are at the beginning, the harder it is then to sustain that support in the marketplace. And I think that's, as you say, one of the lessons here, unfortunately. To be fair, I mean, I think they have performed pretty well. Looking back in hindsight now, you look at the share price performance, it's a very similar pattern to what we saw with things like Scottish Mortgage and all the rest of it. There was that significant period of strong performance after the pandemic. There were kind of relief rally we had after the pandemic. And then it fell away very, very sharply. But if you look at it over the long term, you take the trend line, it's been pretty steady. Where it is today is exactly where the trend has been on average over the whole of its lifetime. Also, of course, we bear in mind that this is the second investment trust that Fundsmith started in the UK. And the first one, which was their Emerging Markets Trust, that didn't last very long either. So I think it's not surprising, perhaps, that Terry Smith has become a little disenchanted with the investment trust sector. And I think style factors have really been a big factor here, as you mentioned. Fundsmith itself has had relatively poor performance over the last few years because of its particular style, investing in large liquid companies with high returns on invested company, quality growth as it's known. That's been out of favour. I suspect that when we look back in 2 or 3 years' time, we'll find that this was actually a pretty good moment to be owning something like Smithson if you continue to have the chance. But we'll have to see about that. I think that this one is going to wind up by March 20 next year is the kind of target date. And of course, the discount has already come in following this announcement. Looking at the sector in which this one trades, which is the global smaller companies sector, there are only a handful of trusts in this sector. Edinburgh Worldwide is one, of course, that's a significant one. Herald also sits in this sector, though it's somewhat different in what it does. Smithson was the largest. And then we've got the Global Smaller Companies Trust, which is trading on a 10.5% discount. Do you think those are vulnerable as well?
Well, I don't think there's too much choice, really. I think that, yes, 2 questions here. I mean, first of all, what should you do with your existing Smithson shares? And typically in these circumstances, I say, well, you should take the cash and then you've got choice over where you reinvest it. But in this case, given what we've said about Smithson and I think its long-term attractions, I can see why you might accept the rollover actually and just continue your investment. If you are a fan of Smithson and their approach, then I don't see why you wouldn't do that. And I'm not sure the alternatives are necessarily that attractive in this global smaller company sector with the investment trusts on offer. Actually, I think the global smaller companies trust is a perfectly good, solid trust. I don't mind that one at all. And I don't know whether there's any further scope for any consolidation here. I don't really see it because these remaining trusts are all quite significant in size. Of course, Herald was one of those initially targeted by Saba, wasn't it? But no, I think these remaining 5 are probably solid enough to remain and stay part of our sector.
Yes, of course, Saba have had an interest in at least one of the other ones as well. So interesting to see what they do next. But they're on a bit of a roll at the moment, Saba. I think it's fair to say they've attracted a lot of flack. And whether or not you regard this as a triumph, it's certainly vindicated their approach as far as this particular trust is concerned. Okay, let's move on and discuss another example of consolidation that we heard about only this morning. We're recording on Friday. And that is Franklin Global Trust. It's been announced that they are going to be merging with Invesco Global Equity Income Trust. And this, again, is another example, perhaps, of the speed with which things are still developing in the sector. Perhaps you could just give us a very quick line on that one, Andrew.
Yes, I wasn't really expecting this one to come about. There was no foreshadowing here. It just was announced. And I think this is probably a matter of size as much as anything, because the Franklin Trust is under £200 million of market capitalisation. And I think these days for a global investment trust, that's just too small. It didn't really have too much that was outstanding to recommend it. Looking at its performance record, it's fairly lackluster over recent periods. And so I think it makes sense for it to combine with Invesco Global Equity Income, which is itself not that big a trust. It's about £260 million of market cap. But if you put the two together, then you get a trust of reasonable size. So my feeling is this merger probably does make sense.
Yes, and of course, it was only earlier this year that we learned that Franklin Templeton took over the management of this trust, which used to be known as Martin Currie Global Portfolio. But the board has, I think, decided that it's better, if you like, to huddle together against the threats of consolidation for lack of size and the other factors you've mentioned. The other thing I mentioned in regard to this one is that they are offering an unlimited cash exit to shareholders, which I think is best practice in this kind of situation. So more consolidation there. A very brief tenure managing this trust with Franklin Templeton. They may be disappointed by this outcome. Let's move on then, and let's talk about another trust which is in the news, and that is Pacific Assets. And this is an interesting story as well. Why don't you fill us in on the details on this one, Andrew?
Yes, talking of short-lived managers, I think that's a nice segue into this one. So Pacific Assets Trust is a decent-sized trust in the Asia-Pacific sector. It's about £480 million, so a quite significant trust. And I remember this trust actually being a good performer for quite some time, but that certainly hasn't been the case of late. Actually, over the last year in particular, it's been a really significant laggard in this sector, really well behind its competitors. And I think part of that is down to quite a lot of turmoil at the managers. Back in August, one of the co-managers decided to leave and move on from the management group he was at. And then there have been further developments since. So the manager is First Sentia Group. They're the parent company of the managers anyway. But what they've decided to do is to close the subsidiary, which was the actual manager here. And they're transferring the management contract to another subsidiary. But in the meantime, that means, again, they are changing the personnel and the actual portfolio managers. And I think maybe there's been a bit of a communication breakdown here with the board. And this emphasizes actually the importance of having an independent board. So the board is disappointed with what's happened and said it's now going to instigate a strategic review. And you and I know exactly what that means, Jonathan. I think it's likely now that the trust is going to hold a beauty parade of managers. And it seems to me, after this turmoil and the recent performance, that actually it's very, very likely this trust is either going to merge with one of its competitors or appoint a new manager from somewhere else.
Yes, I think that is almost certainly going to be the outcome. It's interesting because, this year has been a pretty good year for Asian equities. They've performed pretty well, and emerging markets being part of that. And if you look through the sector, their performance has been disappointing this year, as you say. But going back also, Stewart Investors, they were a boutique firm based in Edinburgh, which had a pretty successful start to life as a boutique firm. But as is so often the case, once they decide to sell out and sell the business to a larger group, things don't always go quite as well as they had done in the early years. I think that's a fair comment. If you look at the Asia Pacific sector, what trust do you follow there? Anything that particularly stands out for you in that sector?
Well, I think there's actually quite a few decent offerings in this sector. I think Schroeder are very strong here, and I think the Schroeder Asian Total Return Investment Company is a good trust. I like the look of some of the income ones. So Aberdeen actually have had a tremendous run with their Asian Income Fund. So I think there are quite good opportunities here to move the money about. In the short term, I'm quite tempted actually to stick with Pacific Assets because you've got an 11% discount there, which is the widest in the sector, although not by much. And you would think there's a decent chance that's going to narrow now. So I wouldn't necessarily jump straight out of this trust if I was a holder. But I think it's an interesting time actually to be investing in Asia. I think there's a strong case to be made for emerging markets now, particularly for investors who are thinking of diversifying away from the US a little bit. So I think it's a sector well worth having a fresh look at.
Well, while we're on the subject of Asia, perhaps we should mention a trust that we mention quite often, which is Henderson Far East. They've had some results this week. What can you tell us about this trust, which has a very unusual distinction in the investment trust sector?
Yes, it's a bit of a bugbear of mine, this trust, actually. It's supported by its tremendously high dividend yield. It does have the highest dividend yield of any equity investment trust, and it's just over 10%. And I think that headline yield is like a siren call for investors, and they're highly attracted by this. And so they've been buying this trust, which trades on a premium rating of about 3%, which is very impressive. So on the face of it, you think, what an excellent combination. High dividend yield, premium rating, everything looks good. But if you just dig into this, and you really don't have to dig very deep at all, actually, I think the picture changes because this trust has consistently been bottom of its peer group by total return, which is really what matters. So I was intrigued, actually, to read the final results for the period to the end of August, because the board has recognised this performance deficit and has tried to make some changes, and the manager has tweaked its investment process. But I was intrigued. The chairman has said with the results that they showed the value of recent changes and they've achieved greater balance, so they're not entirely focused on the income anymore. And he said he was presenting the results with pleasure. So I was a bit surprised then to see they kept on underperforming. And actually the net asset value total return for the year was 12.7%, which is significantly behind its comparator indices. In fact, they're changing their comparator index, but the one they're changing to was up 14.7% in the year. So this trust is continuing to underperform. And I think, actually, this is just a message for us that we shouldn't be blinkered by headline yields. That we really need to look beyond that. And it's total return that matters. So in this case, I'm not tempted by the 10% on offer here.
No, it is a phenomenon, I think one can say. But people are basically harvesting the dividends and not seeming to worry about what's happening to the capital value of this trust. Interesting. But it goes on and it continues to trade at a premium. So I guess the board is pretty much stuck with where they are. You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's talk about another couple of trusts in the news this week. They are related, and that is 3i and 3i Infrastructure. 3i, let's just quickly mention that first, is the largest trust by market capitalization at the moment, and is the only trust, I think, that trades on a ridiculously high double-digit premium. At least it has been trading there, up to about 50% at one point, I think. There's finally been some news out of 3i that perhaps one or two of us have been expecting for a while, which is that its very large holding in Action has for once disappointed its results. Revenue come in less than expected, and the shares have sold off as a result of that. The premium has narrowed. What do you make of this one, Andrew? I don't know if you own this one. I don't. I've always been put off by this very double-digit premium.
I've also been put off by this. I must say I haven't recommended these shares because I've never been able to really comprehend why the premium was so large, and it always felt like a massive risk issue. And that seems to have been true this week. There's been a very big sell-off in 3i shares. Actually, they were down 25% yesterday, so a really massive reduction. And that's really because of a reduction of this huge premium, which has now come down to 17%, but it's still a premium. And we've seen this before with trusts that are very highly regarded by the market, and they trade on a premium for sometimes quite significant periods, but eventually those premiums do always disappear. And in this case, the trigger was the slightly disappointing performance from Action, which is a European discount retailer. And actually, I read the broker's notes on this, Jonathan, and the news wasn't very dramatic. The trading wasn't quite up to expectations, so they're going to slightly miss revenue guidance for this year. But analysts still think they're going to meet revenue guidance for next year. So really, it looks like a little bit of a hiccup in Action. But of course, Action is 3/4 of this in its entire portfolio here. So this is what matters. And I think the problem in the market is that 3i Group shares were really priced for perfection, weren't they? So any little issue is going to cause a big setback. And that's exactly what we've seen. And that's the risk you're going to take if you buy anything on a significant premium rating.
Yes, I mean, it gives you no satisfaction to say that. This has happened because obviously people have been saying this for 2 or 3 years now, and the shares have actually performed incredibly strongly over the last period until this moment. But I think it's relatively easy to say this is how the Magnificent Seven are going to end eventually. The high expectations, the high growth factors that are built into their market's price is going to be disappointed at some point. And if it is priced for perfection, then you're going to see this kind of market reaction. And you have to think, though the businesses are quite separate, this might be, if you like, a parable for how the dominance of the Magnificent Seven is going to end when that comes to an end. But still trading, as you say, on a significant premium. This share has been recommended by brokers despite the premium quite a few times over the last few years, and they have performed spectacularly. Do you think there's any realistic chance that we would ever get back to the premium that we've seen before?
Well, we might, because I think if this does prove to be a small hiccup in Action's otherwise exemplary record and tremendous growth spurt, then it may be that actually in a couple of months' time, everybody feels that 3i is back on track and Action is back on track and people start buying again. But I don't know. I think once bitten, twice shy is a useful phrase to bear in mind here. And I think perhaps once that perfect sheen is rubbed off a little bit, then you never quite get back to it, do you? So my sense is that 3i shares will probably bounce a bit and they'll recover, but I don't think they'll get back to where we were.
I mean, it's actually quite remarkable. You could have actually bought the shares at a discount back in 2022. It's hard to imagine now. But, well, what you mentioned about the sheen coming off would be very true of things like Smithson that we've talked about, or Scottish Mortgage after that went through a period of extraordinary popularity. So, yes, a cautionary tale and perhaps an inevitable one as well, one should say. I mean, that's one to watch. I think that will be interesting to see whether this decline that you mentioned, the near 25% share price decline, persists or not. So meanwhile, we've also had some results from 3i Infrastructure, which is a smaller trust that is managed by 3i and, as its name suggests, invests in infrastructure projects and companies. What did you make of their latest results? Another really, I think you could say, class performer in the investment trust universe?
Yes, very much so. And I have a different view on this one. I have recommended this trust and I own it myself as well. This has been consistently the best performer in the infrastructure group. And it's a bit different from many of the others, which are focused on yield and they're focused on really taking long-term cash flows and returning those to shareholders. 3i Infrastructure is more of an operational trust where it owns the assets and it runs them and it tries to maximize their value. And that's proved to be a winning formula because it has done consistently well. And in the first half to the end of September, again, it provided a good positive total return of 7.4%, which is pretty decent actually for an infrastructure trust. So its net asset value is up to around 408 pence per share. So the shares are on about a 10% discount. So actually that's quite highly rated for the infrastructure sector, but I don't think it's unreasonable. You get a dividend here as well, which is yielding about 3.7%. So you get a reasonable return from that. Something caught my eye in these results, which is that the trust's largest holding is in a company called TCR, which is an airport ground support company. And they're doing really well. Their performance has been very strong and they've been marked up in this recent NAV announcement. But the trust said it's had indications that its strong performance and its platform value have caught the attention of larger private infrastructure funds. So I think the fact that they've mentioned that is code for telling us that that holding may well be sold actually in the next 6 months perhaps. It's 20% of NAV. And my sense is that if the trust does sell it, it will be at a significant markup to the carrying value. That tends to be what happens. So I'm very encouraged by that. And I think this trust is probably likely to continue performing very well.
Yes, I guess they then have the issue of what to replace it with, but that's a kind of nice problem to have, if you like. While we're on this subject, let's talk about a couple of results from two of the premier names in the investment trust sector. I think we can call them that. One is Scottish Mortgage, I just mentioned them, and the other is Fidelity Special Values, managed by Alex Wright, which is the best performing UK equity trust. But let's start with Scottish Mortgage. A lot of people own it. Everybody owns it. What did you make of their latest results?
Yes, I can absolutely remember when literally everybody owned Scottish Mortgage Trust. I'm not sure that's true any longer, actually, because, of course, this was a trust that went through quite a period of difficulty. But I sense they are back on track, actually. And the interims to the end of September were very good. The net asset value total return showed a return of 22.9%, which was well ahead of the FTSE All World Index, up 15.4% over the same period. If you look at this trust in terms of the growth sector, it's clearly the top performer over 1 year with an NAV total return of 18.7. So it's all looking quite good, actually. And it could get better because at the present time, the trust's private holdings, it has about a quarter of the portfolio in unquoted. Its private holdings are not increasing at the same rate as the public ones. So those were only up about 8% in value terms over the 6 months. So my sense is that actually, if the positive momentum continues in the growth sector, then there's a bit of a lag before that comes through the private valuation. So there could be more momentum to come. And I was interested, I've often thought of Scottish Mortgage as being very much dominated by North America, and I've seen that as a part of its high risk profile. So I was quite interested in the geographic breakdown in these results, which showed actually it's 54% North America, which is a bit lower than I had thought. Actually, it's 22% Asia, 17% Europe, 6% South America. So it's a bit more diversified, actually, than I thought. But it's doing well. It's bought back quite a lot of shares. It's trading still on an 11% discount, which is probably just about acceptable. And to my mind, it's still the growth flagship for this sector. I think if you do want to own international growth, then you'll still be considering Scottish Mortgage.
Yeah, I'm with you on that one. And I think particularly we know at the moment, obviously the state of the US market is relevant here because you say its percentage shareholding in US companies has come down a little bit. But the IPO market in the US is going very well at the moment, primarily for venture capital-backed companies coming to market. And obviously that depends on the US equity market itself maintaining its strong performance, which some people doubt. But if we are going to see a significant wave of IPOs, then you would think that Scottish Mortgage is going to be one of the beneficiaries. And then therefore any issues around the fact that private companies may be a drag on the share price and a cause of the discount, that would reverse. So that would be a positive for Scottish Mortgage as well. So let's mention Fidelity Special Values. Alex Wright at Fidelity. Again, another very good performance from them. What are your thoughts on this one?
Well, this trust is number one in the UK all company sector over 1 year, 3 years, 5 years, and actually going much further back. It's been a very, very good trust for a long time. I must say, I own it. I've recommended it. I think it's a really, really good trust. But I'll just start actually by mentioning that I was at a presentation last night actually by Alliance Wittan, and Craig Baker, the manager there, was saying just how difficult it is for top quartile managers to stay in that top quartile. It's inevitable that with any style of investment, it's going to be out of favour at some point or another. And actually, we did see with Fidelity Special Values a little period actually earlier this year where it underperformed briefly. But I must say it's really roared back into form. And for the year to the end of August, its net asset value total return of 14.3% was ahead of the market. Over a year, it's looking very strong against its peer group. And so I really think there's no reason to interrupt my great optimism about this trust and how it's doing. I like its all cap approach. So I think if you're looking for a one-stop shop for the UK, this gives you very broad coverage. So it owns big stocks like Aviva, Standard Chartered, NatWest, names you know, but it also drills down into some of those smaller and mid-cap companies. It takes a value-oriented approach, a bit contrarian. I like all of that, actually. I think the only thing I don't particularly understand or favour is that it does have about 12 to 15% of its holdings outside of the UK. So it owns some stocks in Europe, actually one in Kazakhstan as well, weirdly. But I don't really understand the rationale for having those holdings outside of the UK when we have such tremendous choice here and you can get international exposure through the London market. But that's a small quibble, and it's not going to stop me enjoying this trust and recommending this trust. It's on a 2% discount, no problem there. So I think all is going well for Fidelity Special Values.
I think the only issue there is, as you say, if you were thinking of buying it for the first time, the discount is quite narrow, 2%. Has been wider, often traded around 10% in more recent times. And then they have been migrating, moving a little bit towards smaller companies like a lot of other trusts have done because of the value that they see there. The underperformance of small cap in the UK versus large cap has been very marked. And a number of managers who have that option of moving across the market are moving more into small cap. And then the question might be, well, if you think that's the way the market's going to go, then maybe you might find some more value in some of the specialist smaller companies, trusts, which are trading on a 10, 12% discount. So I think just in terms of relative value for a first-time buyer at the moment, then you might have some cause for pause at this point. But there's no doubt that the long-term track record of this trust is absolutely outstanding. Well, having mentioned quite a few of the best performing trusts in the sector, I guess we've got to mention one that hasn't done quite so well, that's putting it mildly, and that is Hydrogen Capital Growth, ticker HGEN. They have perhaps a woeful record, I guess you can really say, since their launch in the market 5 years ago. What can you tell us about this walking wounded victim?
Yes, it's a very unhappy tale, this one, and it's not getting any better at all. This trust has moved into wind down, and the manager was sacked earlier in the year and replaced by Red Wheel. And they are effectively incentivized to sell the portfolio now, but in doing so, they decided, of course, to revalue the NAV. And they've done that in part because the board felt that the communication from the previous manager was not very good, and that, in fact, there were problems at some of the underlying portfolio companies that they were not aware of. So there's been a pretty broad-ranging review of that. And in the meantime, because the interim results were delayed, the shares have been suspended here. But we do have those figures through now. And it was no surprise to me to see that the NAV was marked down savagely by the managers. They're effectively incentivized to provide us with the lowest NAV they can now because they get paid if they exceed it when they sell the assets. So I don't like that structure. But this is what we've got. And the 30th of June NAV, first of all, was marked down by 54%. So that came right down from 90.4 pence per share to 41.5. And the new manager said this is because the hydrogen market has weakened. And in particular, there's a lack of funding for these companies. So they're all struggling with their liquidity. It then gets even worse. So we had the third quarter NAV as well, and that's down another 17.5% to 34.2 pence. So we've seen the NAV here come down by 2/3 in effect. So this obviously raises question marks about what's going to happen with HGEN itself. And we haven't seen the shares come back from suspension yet. They will do very shortly, I believe. So you'll be able to sell them if you own them, if you wish. But obviously Red Wheel are going to try and sell these assets now. So we'll have to see how they get on with that. They're not selling into a strong market, so I don't know how that's going to play out. And I suppose the other thing that arises from this, Jonathan, is that it does raise further question marks, doesn't it, about NAVs elsewhere in the sector, in the broader renewable sector. We take it for granted, don't we, that actually the valuers and the managers here are giving us as fair a reflection of the asset value as they can. But quite often that is a very uncertain figure, and sometimes it can change rapidly. So a salutary tale here, I think.
Yes, it is one of the problems the renewables have faced, of course, because by nature, the definition, they have to mark their own work, if you like. And it may be that they build in assumptions that are too optimistic. You can understand they wouldn't be in that business, you might argue, unless they were that optimistic. But it can be very brutal when it turns out the reality is not the same as they had been expecting or anticipating. I mean, I imagine this saga will come to an end fairly soon, but it's an example, again, of some of those new trusts that came to the market in the height of that euphoria just after the pandemic. And a lot of these things that were fairly speculative and high risk have come to grief. I should note in passing that it looks like the saga of Home REIT may be finally getting close to an end. The final properties owned by that trust are apparently going to be sold quite soon. So that will eventually lead to the final demise of that particular trust, not being a good advert for the sector. So one has to recognise that there have been heroes and villains over the last few years, and we have to hope that we've seen the last of the villains, if I can put it that way.
What a lovely idea, Jonathan. Sadly, I don't think we ever will. There will always be heroes and villains, won't there? I think much of this is just cyclical and things do recur all of the time. I had an interesting episode this week where, because I'm regulated, I have to keep all of my research for 7 years. And I was going through actually some old papers from a decade ago, getting rid of them. And I was reading some headlines in the trade press at the time, back in the days when we had printed versions, and they were talking about the problems of wide discounts and arbitrageurs arriving in the sector and the difficulties of the investment trust sector. So this has been going on a long time. I think we'll always have winners and losers. This is just how it plays out, and that's why it's so important, of course, to stay properly informed.
Indeed it is, and that is both the charm and the risk that is involved in following investment trusts in the way that we do. It helps to have grey hair, but it helps if the grey hair has been caused by age rather than by investing in too many of these ones that have gone wrong. Okay, well, that brings us to the end of this episode. Thank you, as always, Andrew, for your insights and thoughts. And, well, as you say, we're going to get more of the same, I think, over the next few weeks and months. The investment trust is the sector that never stops giving as far as news and things to talk about is concerned. I should mention in passing that the Moneymakers newsletter has a profile this week of Impact's environmental markets, which is another interesting trust still flying the flag for an approach that is sustainable. And, of course, I should also mention that the Investment Trusts Handbook, in which Andrew is one of the contributors, will be coming out in the second week of December. So not so long now. We sent it off to the printers. I did have to put a little caveat in there to the end of my notes about what's been going on, with saying by the time you read this, even though it's only a month later, there will have been more consolidation going on in the sector, and we're actually seeing it as we speak.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.